Hey guys, today I will be talking about real estate investing. In this video, I'm going to tell you different ways to invest in real estate. So, when you think about real estate investing, the first thing that probably comes to your mind is your home. Of course, real estate investors have lots of other options when it comes to choosing investment, and they are not all physical investments. Let me tell you some key takeaways of this video. One of the key ways investors can make money in real estate is to become a landlord of a rental property. So flippers buy undervalued real estate, fix it up, and sell for a profit. So real estate investment trusts or REITs provide a real estate exposure without the need to own, operate, or finance properties. So real estate has become a popular investment vehicle over the last 50 years or so. So in this video, I'm going to tell you some of the leading options for the individual investors along with the reasons to invest. So let's talk about rental property. If you invest in rental property, you become a landlord. So you need to consider if you will be comfortable in that role. As a landlord, you will be responsible for things like paying the mortgage, property taxes, and insurance, maintaining the property, finding tenants, and dealing with any problem. So unless you hire any property manager to handle the details, like being a landlord is a hands-on investment depending on your situation, taking care of the property, and the tenants can be on 24/7 job, and one that's not always pleasant. So if you choose your properties and tenants carefully, how you can lower the risk of having major problem. So one way landlords make money is by collecting rent. So how much rent you can charge depends on where the rental is located. Still, it can be difficult to determine the best rent because you charge too much. Or you will chase tenants away. So, and if you charge too little, you will leave money on the table. So a common strategy is to charge major enough rent to cover expenses until the mortgage has been paid, at which the time majority of the rent becomes profit. So the other primary way that landlords make money is through appreciation. So if your property appreciates in value, you may be able to sell it at a profit when the time comes of borrow against equity to make your next investment. While real estate does tend to appreciate, and there are no guarantees. So let's talk about historical prices. Real estate has been considered a sound investment, and for good reason. Before 2007, historical housing data made it seem like prices could continue to climb indefinitely. With fair exception, the average sale price of homes in the U.S. increased each year between 1963 and 2007, the start of the Great Recession. Let me show you some chart from the Federal Reserve Bank of St. Louis. Shows that average sale prices between 1963 and 2019, the most recent data available. The area that are shared in the light gray indicate US recession. So of course, the most significant downturn in the real estate market, before the COVID-19 pandemic coincided with the Great Recession. The results of coronavirus crisis have yet to be seen amid closures, social distancing, and staggering unemployment numbers. It's likely that home sales will decline significantly. While that doesn't necessarily mean home prices will follow suit, it will minimum change the way people buy and sell real estate, at least in the short term. So let's talk about flipping houses. Like the day traders who are leagued away from buy and hold investors, real estate flippers are an entirely different breed from buy and rent landlords. Flippers buy properties with intent to build, holding them for a short period, often no more than like 3 or 4 months, and quickly then sell them for a profit. So there are primary approach to flipping property. Repair and update. With this approach, you buy a property that you think will increase its value with a certain repairs and updates. Ideally, you complete the work as quickly as possible and then sell at a price that exceeds your total investment, including the renovation. So then you do one thing, hold and resell. This type of flipping work differently. Instead of buying a property and fixing it up, you buy in a rapidly rising market, hold for a few months, and then sell at a profit. So, with either type of flipping, you can run the risk that you won't be able to unload the property at a price that will turn a profit. This can present a challenge because flippers don't generally keep enough ready cash to pay for mortgage and property for the long term. So, still, flipping can be a lucrative way to invest in real estate if it's done in the right way. So, let's talk about REITs. A real estate investment trust, REIT, is created when a corporation or a trust is formed to use investors' money to purchase, operation, and sell income producing property. So REITs are bought and sold on major exchanges like stocks and exchange traded funds. To qualify as a REIT, an equity entity must pay 90% of its taxable profit in form of dividends to shareholders. By doing this, REITs avoid paying corporate income tax, whereas A regular company would be taxed on its profits, so thus eating into the return it could distribute to shareholders. So that that's for it for today. Hope you like the video about this real estate investing. And if you like the video, don't forget to subscribe and hit the bell again. Thank you again for watching the video. Have a great day.